to part 2 of our podcast on AI. In Plain Sight is back. And back in the same clothes, it would seem. Mike, well done. Managed to find another white shirt.
So I spent last night thinking a lot about the podcast episode that we recorded yesterday. And but yesterday we went through applications of AI that we've heard be spoke about a lot. If I'm honest, the main two applications of AI and trade surveillance that we've heard has been to second fix tackle the dispositioning of alerts, and the other one, which is often proposed by AI natives rather than finance natives, of why don't you just deploy anomaly detection? And I think in the previous episode we went through these, and hopefully we were not short-sighted about the applications of these techniques. They're really powerful techniques, just that we need to be very mindful of how we're going to get the most out of them, and the fact that they're very data hungry, and the type of data that they get is very important.
And I think what we're going to talk about in part 2 now is kind of the experiments TradingHub has done to see how we could improve the acuity of our existing framework, which I think probably lends itself quite nicely to be able to deploy these kind of solutions in very compartmentalized ways and still retain a lot of the explainability that is expected in the market we're all in, right? Which is the regulatory surveillance market.
So Shane, you are famous for your ability to explain extremely complicated technical things using, very, very creative language. So in order for us to talk about how we're planning on integrating AI further into our application, we're going to have to remind our viewers how TradingHub kind of already breaks the trade surveillance problem down, because we're not looking to, I'm certainly not looking to front to back replace the TradingHub approach. We're more likely to be thinking about integrating AI into individual components. So maybe I can ask you to kick us off with a reminder.
No, I'm happy to. And I think the way to think about TradingHub's existing approach, just to remind everyone, is kind of a multi-layered set of thought processes that all sit on top of each other. So depending on which jurisdiction you're in, this could be, like a hero or a trifle or like a Tim Tam, I guess, which is, it's got multiple layers in Australia. And to kind of hold that in your mind as I talk through each of these layers. So the first layer, which TradingHub takes when it comes to approaching the kind of trade surveillance problem set, is to seek to understand all trading activity in the same way that traders understand it themselves. Through the magic of post-production, again, we should hopefully have a slide up where you'll see this top layer where we are taking things like your trade data and your order data and transforming them into market risk. And this is all you're very familiar with this, Mike, from your days on the trading floor back at Merrill. These are transformations into well-understood vectors of market risk, like DVO1, like we saw in part 1, as a way to understand the expression of risk of what you're taking and just to normalize everything so you're looking at everything through the same lens. And this is all very uncontroversial from a financial markets perspective.
Yeah, so every single market-making bank will take a broadly 99% similar approch to turning trades into market risk. The regulatory framework expects this, right? Concepts, well-understood concepts like VAR are based on this. So this is the most uncontroversial thing that TradingHub does, I think.
Well, it's uncontroversial. So I think there's an interesting nuance there, isn't it? Because I think it's incredibly uncontroversial for the front office, but it is novel for the surveillance problem set.
It's novel,
and it's novel,
but
it's
novel.
Not
it doesn't cause controversy.
Yeah, that's true. It's novel, but it's not controversial. But it's
I
a
think
well-understood concept.
And when people hear that we take this approach, there's generally that's actually quite neat. That makes sense. People recognize generally that it's important to present the problem in the same way we were talking about transforming the problem space in the first part. It's probably very useful to transform the problem space, the trades and orders, into the same dimensions that the traders are thinking about them.
Exactly.
And because ultimately the compliance officer's job is partially to replicate the decision-making process of the trader, and then in addition to that, to adjudicate whether that decision making was driven by a desire to manipulate markets or not.
And the beauty of layer one, the market risk layer, as it were, is that it's kind of automatically cross product, automatically cross venue, because it's not thinking.
You're certainly laying the table for
laying
that.
the table for it, exactly.
Yeah.
Layer number two. So, I guess the jam. I haven't had a trifle in a long time. Is it the jam in the middle of a trifle?
So I think you would have started with the sponge.
No,
and that you will
the
be
cream on the top. The whipped cream.
Oh, you're starting from the top. I'm starting from the bottom. I don't know how you can.
Of a trifle.
How do you make a trifle, Shane?
Well, how do you eat one?
This is the difference between an engineer who makes things and a salesperson who doesn't, right?
Fine, fair enough. We've really revealed ourselves. So the middle layer, which hopefully should be the same.
It's going to be like the fruits and jelly and stuff either way, right?
Yeah. Is the market kind of the market impact estimating layer, right? So the reason TradingHub takes this approach is because we've kind of evaluated primary legislation across the world, and the principal prohibition is the artificial creation of a price through the permutation by perturbing supply and demand in a given market. So some specific things are called out. You can't inside a trade. You're talking about, you can't wash trade, you can't spoof, depending on specific legislation. But the primary prohibition is the creation of an artificial price. And what TradingHub seeks to achieve, again, by looking on the slide in front of you, is we seek to model and make a statistical estimate of how your actions in a given market may have changed the clearing level of risk at a common risk domain level. And the way we do this is by ingesting kind of significant amounts of market data to make some baseline estimates around liquidity and volatility in a given market, for example, and to then estimate how your actions may have changed the clearing level of risk, and to quantify that in an estimate of market impact. And that's the second layer. And importantly, through layer one and layer two, we've not actually run any surveillance yet, right? We've laid the table via market risk, and we've made a series of statistical estimates as to how market impact may or may not have been created.
I think that's exactly it. And if you and apologies for people who've heard this before, but if you think about how those two layers work together, it's quite neat. So layer one, turning trades into market risk, understanding the common factors that they might be sensitive to. And then layer two, thinking about how trades and orders change the value of those common factors. If we were to flesh that out into a real world example, and the example I normally give is, imagine that someone starts buying bond futures very aggressively. Now, if we were to think about market impact, first approach, we would be talking about the price impact that we were creating in that bond futures market. I'm buying aggressively, I'm clearing out the offers, I'm pushing the price up. But it's so much more helpful for the surveillance use case to be thinking about market impact through those latent market risk variables. So don't think about what you're doing to price, think about how you're changing the yield environment. So you're buying the bond futures, what you're really doing is pushing yields down, and you'll be pushing yields down potentially quite broadly across the yield curve if you're doing it in enough size, but certainly concentrated around the maturity of the bond future. And if you change the yield environment like that, you're changing the clearing level of more than the bond futures. So of course, if yields go down, that bond future is going to go up in price, but so will cash bonds that are at a similar maturity point. The clearing level of swaps will also be altered. Swaptions, caps, floors, corporate bonds, anything which is expressing sensitivity to similar points in the yield curve will have its clearing level changed. And so the neatness of this approach is, you're exactly right, it's not surveillance specific, but it provides an environment that can answer, from TradingHub's perspective, the principal question. If you trade or put an order on anything, what's the likely estimate of the price impact on everything else? So a couple of key things: estimates, not forensic, it's statistical. But given, as you said, that legislation speaks to supply and demand imbalances, creation of artificial price, given that enforcement action accepts the fact that the artificial price can be created in one market and then monetized in another, this framework is super, super powerful for thinking about this kind of problem set.
And I think you then get to, that's exactly right. And you then get to the final layer or the first layer, depending if you're an engineer or so, the cream or the sponge, I guess.
The custard, surely on top,
custard.
no? And then the cream.
No, but what's at the bottom of a trifle? Sponge, no?
Yeah, a sponge.
Yeah, and then the top is cream. So this is either the cream or the sponge, depending if you're an engineer or
Okay,
a sales
fine.
person.
It's a long time since either of us have had a trifle, it appears, because none of us are that sure.
These are the surveillance scenarios, right? So these are the very well understood intersections of concepts. Like, for example, if you are to drive a price in a certain direction and then capture the benefit, we would call that ramping. If you were to perturb supply and demand by flashing a large order on a screen and then capturing the benefit via a smaller bona fide order, you'd call that spoofing. These are, again, very well understood intersections of these two things, of an artificial price being created and the benefit being captured. And this, again, what you're hopefully seeing on the screen is the framework through which TradingHub operates today. Now, I think, Mike, you have some graphs to illustrate the market impact layer a bit further, but hopefully, just to kind of drop some breadcrumbs a little bit, it should, we've spoken about these three layers. You can hopefully see, as a listener, where TradingHub is thinking of deploying artificial intelligence to improve the acuity.
So, look, these three layers, the market risk layer, there is really no further improvement that we can do. We aim to approximate and to converge to the market risk models that are used to drive trading decisions, and so we should just be trying to replicate those. The detective scenarios, given your framework of that, this price estimation, if you trade anything, what's the price impact on everything else? Given that framework, the scenarios that you're looking for are really quite straightforward.
Yeah,
they're well understood, and in addition, if you think about machine learning, you have to ask and worry about the training sets. There are, a handful, fewer than 40 publicly available enforcement actions that are relevant. Certainly not enough really to build out a learning data set. So it's this middle layer, this market impacting layer, which is most interesting for TradingHub in order for the systematic application of AI. So this is a critical part of our modeling. So if we improve the accuracy of this middle layer, we will improve the output of all of our surveillance scenarios. It's also an area where there's lots of training data available. One of the things that at TradingHub we've been working on a lot recently is the integration of L1, L2 order book data. And that has given us access to an incredibly large data set of order book, trade, high granularity price evolution, exactly the scale of data set that you need for some kind of supervised machine learning, aiming to estimate the future evolution of the market given the trades and the orders that you're about to hit the market with. So an obvious place for us to explore the application of AI. And just before we go into how our current market impact works, because obviously we're going to need to measure any improvements against what we already have, it's worth probably just pointing out that yet again, TradingHub is staying true to form in kind of co-opting ideas created by cleverer, better paid people in areas of high finance and incorporating them into trade surveillance. So we mentioned at the beginning, market risk is not a TradingHub invention, right? Like, people have been using market risk to think about trades for at least 40 years. And, people have made their careers on making advances on that. And the novel thing that TradingHub's done is to take that learning and apply it to trade surveillance. Similarly, high-frequency trading firms particularly have been using machine learning for at least a decade in order to, predictive analytics, in order to estimate statistically price evolution in one market given order imbalance in another, for instance. This is the basis of many statistical arbitrage strategies. And I think, Shane, you and I were at a conference maybe 18 months ago where Ken Griffin was speaking and, mentioning, the good decade that Citadel Securities had been deploying these kind of techniques. So again, to some degree, we are playing catch up with actually the way that the market actually operates by incorporating these kind of techniques into our understanding of the market and then building our surveillance on top of our understanding of the market.
And I think it actually is quite interesting because you mentioned the 40 public enforcements. And when you read some of these, it's possible to see human beings, human traders, understanding that the other side is operating via this exact framework and therefore taking advantage of some of these statistical arbitrage algorithms by trading in one market and being able to predict very reliably what's going to happen.
I think there's some pretty fruity instant Bloomberg chats in one particular enforcement case where there is I won't give the name of the firm, but there is a senior trader, I think, speaking to a colleague and essentially saying exactly that, like this is how you get the ABC algorithm to hit your bid, essentially. Okay, so if we're about to really think the unthinkable, think that we could improve on our existing market impact model, we should just remind ourselves what that market impact model is. And also, let's be frank about maybe some of the areas where it could be improved. So our current market impact model is a mathematical framework which seeks to be able to estimate the price impact of trades and orders in any market, right? So it's designed to be incredibly broad in its application. Now, of course, all markets are different. And the clever folk at TradingHub have recognized this and have sought to make this same mathematical framework be applicable to different markets by factoring in characteristics of markets in general. So if we agree that, for instance, buying something makes its price go up, the degree to which that is true will depend upon some of the characteristics of markets. So very volatile market environments or very volatile markets where there's a high degree of price uncertainty, you will find that providing or taking liquidity from those markets will produce a bigger price impact than from less volatile markets. And so volatility is an input factor into our market impact estimation. Similarly, liquidity and the degree to which different risks have a different depth of book, whether visible or invisible, will determine the size of market impact in different environments. So, if I was to trade $100 million of 10-year US Treasuries, I would create a price impact, but I would create a greater price impact if I traded 100 million euros or the equivalent dollar amount in Danish government bonds, right? Kingdom of Denmark government bonds, because it's a much thinner market. So I would be consuming more of the available liquidity and having a bigger price impact. So these are important ways that we try and make this single market impact model, this critical part of our calculation, applicable to all markets. But there are some problems with that. So fundamentally, there is more that separates markets than simply volatility and liquidity. Some markets are more institutional in their flow, and the average block size is larger, for instance, and there might be fewer larger trades, but the same amount going through as maybe an equities market where the trading's more continuous. I think we have another problem, which is we can't, the general form of the market impact model, the general mathematical formulation of it, that's been chosen by a human engineer, essentially, to all extents and purposes, discovered on a tablet of stone up a mountain, and then fitted as best as we can to the data that we observe in the markets. But it's not, therefore, completely 100% data-driven. And consequently, these two problems, the fact that we're not really identifying all of the differences between markets and that there's human decision-making in the design, they create environments where sometimes our market impact modeling is not accurate. So there will be some markets where we produce over estimates of market impact. So maybe illiquid credit would be a good example. And consequently, we overscore scenarios in illiquid credit, and that might result in high numbers of false positives. That's a bad outcome for our customers. Another example might be the inverse of that, where there might be some markets where we underestimate market impact and therefore underscore. And that's also poor, because then our customers, in order to ensure that known productive alerts will fire, they will then set thresholds low, and that will create false positives because you've just generally lowered thresholds. So these are areas we could definitely improve. And if we can improve the acuity of our market impact modeling, that would be an improvement. But there are many, many good things about our market impact approach, and I will just whiz through them now, because our market impact model is something which I think rightly, despite the fact that it could be improved, we're quite proud of at TradingHub. So I've used some illustrative examples, all based around trading Australian government bonds. And on the first slide that we're going to display, I show two graphs. So the bottom graph shows the position build over the period of a minute. So you can see over a period of a minute at 5-secondly intervals, we are buying 30 million Australian dollars worth of 10-year Aussie government bond. And the graph on the top shows our market impacts model estimates of price impacts. Now that price impact has been calculated via all of those risk dimensions, but it mapped back onto the instrument in question. And we can see several things, right? So we can see that buying 5 million of the Govy bonds, that first step up on the top price, that we estimate that will move the price by about 5 cents. By the time we've bought 10 million, we'll move the price more by 8 cents, by 15 million, 11 cents, and so on and so on. So you can see that in all circumstances, buying more moves the price more. And because we have a mathematical construction for our market impact model, we know that is the case at all time in all markets, right? There is no market where buying more will move the price by less than buying less. Secondly, you see that there is some curvature to the response. So moving the price further and further away from its natural clearing level becomes increasingly hard, right? Just applying technical buying pressure onto a security, moving the price further and further away becomes harder and harder. And I think that's desirable. If we look at the next slide, we get to see the evaluated price impacts under different market conditions. So the teal line on the top graph now, that kind of turquoise color, that represents an estimate of market impacts were volatility to have increased. So all things being equal, our market impact modeling says that when volatility increases, markets are more twitchy, the price impact of a given pattern of trades will be greater, and always will be. We can say with certainty that if volatility increases, we will not produce lower scores. We will produce higher scores in all circumstances. And similarly, the magenta, that kind of pink line, that is drawing the impact of liquidity drying up. So I think here we've halved the liquidity. So the order book is much thinner. The market therefore responds greater to an imbalance in supply and demand. And again, the mathematical construct of the market impact model means that this is always bound to be true. And then the next graph, we zoom out a little bit and we see an additional feature of our market impact modeling. So when we look at that same pattern of trading, not over 1 minute, but over 5 minutes, we start to notice that over time, when we stop providing or consuming liquidity from the market, that the market will start to converge back towards its natural clearing level. So our price impact, the deviation in price that we've caused, what we're plotting on the y-axis, that starts to decrease. And if we zoom out further and we look over the period of an hour, we see that in this example, after an hour, it's completely evaporated. And we see some interesting things too, that we see that price impact decays faster when liquidity is high at the black line than when it's low in the magenta line. And again, I think that's super desirable. And again, this is something that we can say will be true in all markets at all times because of the mathematical nature of our market impact model. So then the final graph that I want to show is just this market impact model applied not just to trades, but to orders. So again, we're looking at that same 10-year sovereign Australian government bonds, and the x-axis is size, the y-axis is price impact, and the black line is the price impact of trades. So here we're seeing again that $5 million being executed, moving the price by a bit less than 5 cents, 4 cents or so. We then get to see what the equivalent price impact would be for orders of the same size, but of different competitivenesses. So the magenta line shows an order which is at the touch, so it's at the best price available. We can see that it's creating also a positive price impact, but it's strictly always less than the price impact of a trade. So buying a bond does take liquidity away. Offering to buy a bond threatens to take liquidity away, and therefore may or may not, and must by reason have a less price impact than the trade. And then we see, again, as we move the order further and further back from the touch, 1 cent, 2 cents back, we see always that the price impact decreases. And again, mathematically, we know that this will always hold, this relationship, because we have a mathematical well-designed market impact model. But as I said, that mathematical well-designed market impact model has come at some cost. It's not as defensible as a data-driven one. It is that mathematical formula, if you excuse the analogy, was found on a tablet of stone up a mountain. The degree to which it matches reality is something that can be challenged. And we obviously want to match reality as well as we possibly can, because by doing so, we will most cleanly be able to adjudicate between the high risk and the low risk patterns of trading.
And I think it's worth pointing out that this tablet of stone that you mentioned, I mean, this is TradingHub today. This market impact model is in use by all of our customers globally and has been through the kind of stress testing of model validation teams.
100%. So look, I mean, the thing with models, and this is not just trade surveillance models, all models, is that they seek to provide useful insights about reality, but they are simpler than reality, and they make simplifying assumptions. Right? Yeah. So, Black-Scholes makes a simplifying assumption. It assumes that price moves are log normal. Now, they're not, right? And therefore, you need to have a vol skew to kind of accommodate for the fact that, the underlying assumptions of the Black-Scholes model are inaccurate. It does not mean that Black-Scholes is not useful into pricing options or engaging in risk management or thinking about all kinds of things, anything which really is driven by volatility. But of course, the universe reality is more complicated than those Black-Scholes equations, no matter how elegant they are.
Your famous line is that creating another universe, replaying the universe is expensive, right? And therefore, that's why
it's very true. I mean, the alternative to a model is to play the tape again. Yeah,
and it costs a lot of money.
Yeah.
So I think at this point, probably we've been quite explicit about the layer in which TradingHub is looking to deploy this kind of improvement techniques via AI and machine learning. And I think you also, sorry to put you on another speaking frenzy here, but I think you also have the output of some of the experiments we've run based on this L1 and L2 data that we've recently acquired.
Thanks, Shane. So we can flash up a graph here, which is taken from our L1 and L2 data. So this is intraday price moves for Apple. So, a US equity, clearly on the screen, you can see the teal and magenta line. So that represents the best offer and the best bid, or the other way around, best bid and best offer retrospect. So on the graph, you can see the teal and magenta line representing the best bid and the best offer. And you can see those moving over time, largely horizontally, but maybe trending ever so slightly down. And then also on this graph, we've got some vertical bars, which represents times where bids are being hit. Now, for the next few slides, I'm really just showing the outputs of some of our early experiments with AI for order book prediction. So in these graphs, I'm really going to be focusing only on one side of the market. I'm going to be trying to think about whether or not we can predict, given the balance of the order book and given the emergence of maybe an imbalance in the order book over time, whether or not we can predict whether or not the bid is likely to be hit in the next time step. So on the graph, we can see here what actually happened. We can see the evolution of best bid and best offer, and we can also see the actual occasions where the bid was hit. And we can also see via the height of those lines and the right-hand y-axis, we can see how much of the bid was hit. Now, so this experiment, one of the experiments that we did was training a long short-term memory neural network. So this is a neural network which will take a vector input. So it will look at the state of the order book at multiple price points, and it's got memory associated with it as well. So it will then kind of create a hidden state, which will be updated as time ticks by and as the order book shape evolves. And it will use that in order to be able to build an understanding, not just of what the order book looks like, but potentially the momentum that is emerging inside the order book. And all of this can help that neural network predict whether or not a bid is likely to be hit or not. And on the bottom graph on the screen in front of you now, you see the outputs of that neural network. So you see this gold line, which is the neural network's estimation of the likelihood of a bid strike. And you can see straight away a few things. You can see actually in the short term, the neural network's pretty good at, for this given period of time, maybe not for all time, but for this given period of time, this neural network seems to be doing a good job of looking at the evolution of the order book and estimating whether or not it's likely that a bid will be hit. It's not perfect. So you can see that first bid strike, it didn't see that one coming. But those second two bunches of bid strikes, when they occurred, it was pretty confident that they would happen. Now, this is not a market abuse detecting algorithm yet. But you can see that this is clearly something that would be useful for a market abuse detection. So if we can predict the likelihood of a bid strike given an order book journey, and then we can isolate your impact on the order book journey, we can isolate the orders that you put on the screen, we can isolate whether or not you were responsible for a significant increase in the likelihood of the bid being hit. And you can see that might be quite useful in a scenario like spoofing. So, maybe if you had an iceberg order on the bid and you were kind of changing the dynamics of the order book in a way that increased the likelihood of a bid strike, that might be quite an interesting thing. So on the next slide, as with the earlier explanations of machine learning in the previous podcast, it's kind of important to make sure that as a human that we look at how the order book was evolving and see if we can reason about how the ML might have reached its conclusion and whether we broadly agree with it. Maybe it was just lucky. So on the next slide, I'm showing you the state of the order book. In fact, more precisely, just showing you the three most aggressive bids and most aggressive offers and how much size was on them at this critical point in time where the algorithm starts becoming very confident that a bid will be hit. So at time series number 5, you see that we actually present the algorithm with a very balanced order book. So there's really no, given that very well balanced order book, the algorithm's reached a conclusion, unlikely that a bid will be hit. As we roll forward one tick, we see the arrival of a reasonable amount of extra liquidity offered 1 point back from best offer. And we see a corresponding modest increase in the bid strike likelihood. And then finally, rolling forward one extra time step, we see 2 new bits of information, and we can probably infer a third bit of information. So we see the arrival of more liquidity on the offer, this time at the most aggressive price point. We also see that the bid is hit already. So, the fact that some liquidity has already been taken from the bid seems to make the algorithm confident, given that there's not much liquidity left, that it's going to be hit again. And the thing we might be able to infer is that there is some kind of modeling of momentum going on here. So we are becoming much more confident of a bid strike, not just because more size has become available at the best offer, but there is now a pattern of this order book becoming over time more and more offered. And worse than that, from the perspective of someone who wants to sell, we are seeing that the bid is getting hit and is in danger of walking away from us. So you can see that the algorithm is taking into account features of the order book which almost certainly a trader or a surveillance analyst dispositioning the state of the order book would find relevant. So what are we seeing here? So we are not seeing something which is ready to incorporate or replace our current market impact model. We are seeing merely, and this should be no surprise, that the state of the order book and its evolution over time provides some predictive value as to what will happen next. In order for us to incorporate that into an application like MAST, we would need to do a lot more. We would need to make sure that all of those properties that we have currently managed to mathematically encode and force into our current market impact model, properties such as larger trades or larger orders always creating bigger price impacts than smaller trades or smaller orders or less competitive orders, and always been true in all circumstances, and that price impact decays over time so that 10 minutes later the price impact is always less than it was 5 minutes later. These kind of relationships we would need to make sure were not thrown out with the bathwater. So it's quite potentially easy to train a neural network some data sets to produce good estimates of what will happen next. There's always the danger that when it sees something that it hasn't quite seen before, that it starts to produce wildly inaccurate estimators of what will happen next. And we would need to think about things like the error function, like we mentioned in episode 1, and how we can design an error function to force the machine learning to produce a model of the universe which still obeys some prior knowledge that we have, prior knowledge along the lines of large trades producing bigger impacts than small trades.
And that's very important. I mean, you mentioned earlier the world we're in, where markets are in a constant state of excitement, breathless excitement, I think is the word you use. And we would need to, you're right. So this, I think, importantly, we wanted to share, as we did at RegHub, with our kind of listeners, the direction of travel in which TradingHub is thinking. Like, we don't have all the answers yet. These are the outputs of experiments we have run. And we also recognize that every customer of ours, from an institution standpoint, is at a different stage of their kind of own internal AI adoption capabilities. So this is something that if we were to ever get to a production state, would be configurable and as an optional module. Or not.
I think, going out from the academic exploration of AI for a minute and speaking back specifically about TradingHub, one of the benefits of our approach to surveillance generally is, as you described so well earlier, Shane, it's very modular. So we have these 3 layers, they sit on top of each other, and they seek to speak or model some truth. So we have one level which turns trades and orders into market risk. And if we wanted to make an improvement to that module, we could do that, and we could offer that improvement to some customers and not others and leave them on the old one if they preferred. Similarly, given some market risk, how can we estimate the impact on clearing level of trades and orders? Now you can use a mathematical, strictly defined, designed market impact model like the one that TradingHub currently deploys, with all of the benefits that has, and like any model, with the compromises that it entails. Or you could elect to use an AI enhanced version when such a model becomes available, but there's not going to be a requirement to pick up an AI enhanced model. You can just swap one module for the other, and that will be up to individual customers. Yeah, I think that's really worth stressing.
Okay, so I think we're at the point now where at RegHub we moved to Q&A.
I think everyone just wants to know what you're doing with all of that bleach at 3 a.m. Shane.
Well, maybe you should ask an AI what I'm doing with it, right?
Yeah.
Okay, so I think this gets us to the end of part 2, Mike, no?
It does, yeah. So thank you for listening. And I'm sure we'll be back in the not too distant future with some more content.
And with Andrew, I think.
Oh, I don't know. Let's wait and see what the audience feedback is.
Thank you, everyone.